Good morning. My name's Ryan Littlestone from forexflow.live. Today we're going to talk about these Fed expectations and how the patterns changed over the last week or so. Pretty much the market has been banging on for a cut in July from the Fed for the last few weeks. Pricing has been 100% certainty as they see it. But what's been shifting is the difference between whether they're going to cut by 25 basis points or 50 basis points. And then that was reinforced last week when we had Jerome Powell come out in his testimony statement. And he painted a pretty dovish picture of everything going on. We've spoken about it previously, but the US economy isn't doing that bad. The jobs picture's doing well. Inflation, it's not that bad. It could be doing better, but it's not, anywhere near deflation or anything. The consumer's doing well as well. So we're not really seeing any really negative data, but Jerome Powell, he was fairly dismissive of the jobs market last week. He said it wasn't running hot, wages could be better. So the question is, how much better does he want the US economy in the current climate of the rest of the world? But what that did, that reinforced the market's view of a Fed cut coming in July. And so what that's done is we've seen the pricing come in. We saw bond yields drop in the US down to down around the 1.9% area, 1.95. But then we saw that move reverse. So what that says to me is that we're pretty much priced in now to what the Fed can do. Personally, I still think there's a chance they don't cut rates, but you can't ignore what the head of the Fed has said, and he's primed a rate cut, and so that's what we've got to expect. So what we have to look for now is what's the trade from that. I'm still in favour of fading any move that happens. So I'm looking at shorting bonds once again, shorting those 10-year bonds because we're still down around this low level 2.10 area, 2.05 area, and if what we're going to get is an insurance cut from the Fed, then we could quite possibly see a bottom in those yields, and that's going to cause the price to drop as the yields rise. Conversely, obviously, the US dollar is a trade to look at as well, pretty much against any pair you want to pick, because we are pretty much priced in now. So unless the Fed come out super dovish and indicate that they're going to be in a proper rate cut cycle, this is pretty much going to be nothing more than an insurance cut. And if that's the case, then the market is pricing this heavily to the more dovish side, and there's going to be some unwinding in that trade there. So of course there's lots to happen in the meantime. We've still got the US-China trade news bubbling under the surface, Brexit, Iran, you name it. There's lots of plates still spinning in the air. So what we've got to watch is into the Fed meeting at the end of the month is just whether we're going to get a chance to pick up some cheaper levels in the dollar, or whether we're going to be able to hit some of those bond shorts if the yields drop back down again. So that's what I'm looking at towards the FOMC. Pick your levels as always. Look at your charts. If you take euro dollar, for example, we're still in this 111, 115 range. So if you get a chance to get in at any of those edges, that's something to look at if we're in there before the FOMC. Aside from that, we've just got to see how the expectations unfurl. We've still got one big piece of data in my mind to make or break the Fed case, and that's going to be the PCE report, which comes in, I believe, the day before the FOMC. So that's something to wait for, because that's the Fed's measured. That's the inflation measure they like. If that comes in stronger, it's going to put the cat amongst the pigeons again. So lots of water to go under the bridge until then. So we'll keep watching the markets and see how these expectations change. And very good luck to you.